Good evening, participants. Welcome to our webinar on Equity Market Insight, where our experts share the updates and insights on the global and domestic market trends, equity market valuations, and outlook. And we also deep dive into one of our fund's strategy. I'm Sonal Mittal, product specialist at UTI Mutual Fund, and I'm joined by our CIO, Mr. Vetri Subramaniam, and fund manager, Mr. Vishal Chopda, who will be talking about UTI Consumer Fund. Please post your questions on the link provided to you to make the most of this opportunity. Without further ado, I will now hand over to Vetri. Thank you.
Good evening, everybody. Thank you for joining us on this edition of the Equity Market Insight. It's obviously been a very busy week because it's been at the start of the week, we had the budget. And by the time we could analyze the budget, everybody then shifted their attention to analyzing the tariff announcements that were coming out of the US and the new incoming administration of President Trump. And then by the time all of this could get digested and some tariffs getting, temporarily delayed, you run into the Monetary Policy Committee in India. So all in all, a very exciting week with many interesting things happening. And therefore, in today's Equity Market Insight, we're actually going to just do a little bit of each thing, which is to say we'll touch a little bit on the budget, touch a little bit on monetary policy, and touch a little bit on US economic policy and tariffs. So without any further ado, let's move ahead to the first slide. So if you think about the trade war and tariffs which US has been which they announced last Saturday, and then of course they've delayed the tariffs against China, against Mexico and Canada temporarily, but they've gone ahead with the tariffs against China. It's instructive to remember that this is not the first time that the US has done this, correct? In 2018, President Trump did this again in terms of implementing tariffs against China. And the slide that you can see here, both on the left and the right, show you exactly what happened the last time around. So the light green line at the top is the US total trade deficit. And as you can see on this chart, starting from November 2014 till date, it has only gone largely in one direction. The general trend has been upward. The blue line that you see below that is the trade deficit with China. Now, what you can see over there is a sharp collapse in the trade deficit, but that's really the pandemic impact. Post-pandemic, it pretty much fully recovers back to the pre-pandemic level. So did the tariffs that the US implemented against China have any impact? Slightly debatable, but what you can see is that the blue line doesn't fully recover to the previous peak post-pandemic. It sort of settles down slightly lower at about, when you need to look at the left scale over there, it settles down at about $300 billion vis-a-vis the previous peak of about $400 billion. But what appears to have happened is that during this intervening period, a lot of China-based production actually ended up moving to some other countries, primary beneficiaries being Mexico, Vietnam, and few other countries in Asia, the so-called China Plus One strategy. And therefore, the gray line, which shows the US trade deficit with certain emerging economies, goes up to the extent that it completely covers the reduction in trade deficit that happened vis-a-vis China, which is why when you look at that top green line, even though the US tried to rein in the deficit during President Trump's administration in 2018, the US has not really benefited in terms of a reduction in trade deficit. All that has happened is that the trade deficit with China has come down to some extent, and that trade deficit has moved to other countries where it would appear that China has transferred some amount of its production capacity. This is also visible when you look at the chart on the right-hand side, which is that China has lost share in US imports, which is that blue line that you see, and it starts to come down. Actually, even before the tariff started from sometime in 2016, the share of US imports starts to come down. But if you look at it in another way, what is China's share in world exports? It turns out that China's share in world exports has continued to go up. What this means is two things. One, Maybe China has managed to reshore some of its own production to other geographies who have exported it to the US. And secondly, China, just being so competitive, has managed to gain market share in other parts of the world as well. So net, the conclusion from this slide, the China export machine remains very, very formidable. B, they seem to have managed to shift some of their production, even US facing production, to other geographies, and which is why neither has the US trade deficit come down as a result of the 2018 tariffs, and China's dominance of global manufacturing is intact. Uh, Moving on to the next slide. What actually happened when President Trump came the last time and did these tariffs? In 2018, you can see on the left-hand side, one is the reaction in the dollar, which is the yellow line, and the other is the reaction in the US 10-year bond yield. Now, when the trade war first started, it was a textbook reaction. People worried about the impact on inflation. The dollar started to move higher. 10-year yield started to move higher. But at some point of time, even before the pandemic, things started to change. There was a growth scare in the US. Yields started to fall, even though the US dollar remained very, very strong. So the question is, going into the current round of trade war, the setup looks very similar, except because we already know what happened the last time around, you can actually see that both the US dollar and the US yield start to spike even before President Trump gets elected, right? Because by September, October, the market started sensing the probability of a Trump victory was high, and therefore it actually reacted right at that point, because they knew that tariffs was the favorite, or rather a beautiful word as President Trump has described it, and you see the similar response come through. Will we get a growth scare? Will USD yields roll over? We'll just have to wait and see. Every time is slightly different. It never really rhymes perfectly. So those were the first two slides talking about, President Trump, who's dominated the headlines over the last few days. But let's change our perspective from there and come back closer to home and look at some of the implications of the budget. Now, if you really ask me, I think some of the attention on the budget in terms of it being a big event for equity markets is more and more something which used to happen in the past. Because today the budget has reduced the scope in which it tends to operate. For example, GST duties are no longer something which is done in the budget. It is done by the GST Council, right? So no scope for change in excise duties, but largely speaking in the budget. Customs duties in the 90s were very high, but over time we've brought it down to very low levels, and there is not too much happening in customs duties, because then you run into other kinds of issues. So really it's all about certain changes in tax laws, and it's more about the impact on the fiscal deficit, which would actually be more important for bond market than equity market. But if I were to tell you in one line what is really the most important part of this budget, I would say it is the fact that this budget was used by Finance Minister Nirmala Sitharaman to once again sort of ensure India's macroeconomic stability, and to, I would say, in some senses, ensure that India's macroeconomic platform remains very strong for us to be able to achieve our aspirations for sustained growth over a long period of time. Now, on the left-hand side, you can see the fiscal deficit. In 2021, when the pandemic hits, the fiscal deficit doubles. But India is one of the few countries around the world where over the period of 5 years, we have halved the deficit from the worst year, which is 2021. From 9.2%, we've brought it down. A targeted level rather for next year is 4.4%. So this is a dramatic compression of the fiscal deficit, which we've carried out, so much so that it has come back, I would say, more or less to the pre-pandemic trajectory. Of course, in 17 and 18, it was lower, but I would say the quality of fiscal reporting at that time was also not perfect, certainly not as good as it today. So pretty much we have brought the fiscal deficit back to pre-pandemic trajectory, which is unusual because in most developed countries, the current trajectory of fiscal deficit is way above what it used to be in the pre-pandemic territory. Finally, debt to GDP. The government used this budget to say that from here afterwards, in order that we retain some flexibility to respond to near-term dynamics, we will now shift our focus from annual fiscal deficit to a more medium term target. What is the medium term target? The medium term target is debt to GDP. Now you can see in this table, in the pandemic year, India's debt to GDP spikes. It goes up from 73.1% of GDP to 91% of GDP. From there, it's come down to 83% of GDP. Similarly, central government debt to GDP is currently about 57%. But they have now articulated a target which will involve them reducing the debt to GDP of the central government from 57% to 50% over the next 5 years. So this is a very significant sort of commitment to fiscal consolidation, and I think this ensures India's macroeconomic stability is in good health. What was the other big takeaway in this budget? We can move to the next slide. There was a lot of focus going into this budget about capex. The reason there was so much focus on capex is that, remember, when the pandemic hit, one of the excellent policy initiatives of Government of India was to say, let's press the pedal on capex to the extent that we can, so that we are able to provide a positive fiscal stimulus to the economy. And during this 2020 to 24 period, capital expenditure carried out in the central government budget went up at a CAGR of almost 30%. But given the overall context of fiscal consolidation, it would appear that we are now starting to slow down the pace of capex. So from the base of FY24, capex went up in single digits in FY25 and is expected to remain single digit territory in terms of growth in FY26. So compared to the 20 to 24 period, we are now entering a period of slightly more moderate capex growth. But keep in mind that this is happening during an environment where we are not taking our foot off the pedal as far as fiscal consolidation is concerned, and the medium term target has now become debt to GDP. So what did the government do in response to some of the things that it's seeing in the economy at this point of time? While they did not step up on capex, you can see the big initiative that they took in this budget on the next slide. Really, the way to think about this is the government really took another big supply side initiative. Remember, in 2019, they cut the tax rates on companies very significantly down to 25%. And in fact, new enterprises, manufacturing enterprises, they said we'll have a tax rate as low as 15%. This time, they've done something similar for tax-paying households. Effectively, they've brought down the impact of taxation on households. And you can see over here, based on the kind of income that the particular taxpayer has, this is the amount of savings that they would get in terms of their annual income. So what the budget really does is that it exercised a choice. Rather than take, and the amount of this tax giveaway appears to be about 1 lakh crores, as the finance minister said in the budget, rather than collect 1 lakh crores from the public, because remember, government doesn't have its own money to spend. They collect taxes from the public and then decide how to spend it. So the government took a very wise decision, in my opinion, in this budget, that rather than collecting 1 lakh crore from the people and then deciding, shall I put it in capex, shall I use it to do fiscal transfer, shall I choose to do something else, let me leave that money with the households by reducing the tax rate, reducing the tax burden, and then the households can decide, each household can decide what is right for that individual household. Some households might decide to pay down debt, some households may decide to invest that money, and some households who are perhaps feeling the pinch might say, okay, let me use some part of this income to actually increase my consumption. So I have seen many discussions talk about, is it investment focused? No, they have changed to consumption focused. I think that is a wrong perspective. It's an incorrect perspective. Let me put it that way. I think what the government has really done is left resources with the households in the belief that eventually individual households will do what is best for their household and their family, and they are the economic constituents who really drive the economy. So I think this is a very far-reaching change that they have considered. There are other issues about, should the tax rate incidence be as high as 12 lakh, but that's a different debate. But I think this is a very far-reaching decision that they have taken to say, let's leave the resources with the household and let each household decide what is most appropriate for them. Some might choose to buy a house, some might choose to buy a car, some might choose to go on a holiday, Some might choose to pay down debt, and some might choose to invest in a mutual fund. Let's leave it to the household. So I think that's really the thrust of what the government did in this budget. It's a supply side initiative, leaving money in the hands of households. Yeah, we'll quickly move on to the economic indicators. I won't spend too much time here. This is the professional economist forecast as per Bloomberg. So FY25 real GDP growth about 6.3%, and FY26 forecast 6.5%. Just today, of course, we got the MPC and the RBI talk about their expectations. They're expecting 6.4% for FY25, going up to, I think, about 6.7% in FY26. But largely, I would say, sort of, maintaining the current trajectory. Today, of course, they cut the rates by 25 basis points. Our belief was that this was also always going to be a slightly shallow rate cycle. There isn't too much scope for them to cut rates. The RBI's own target for inflation, or rather the forecast for inflation for FY26 is 4.2%, not very different from the number you see there of the professional forecasters, 4.3%. So we think most likely you can get another 25 basis rate point sometime during this year. If you really get lucky, it could be 50, but really, as I said, it's a shallow rate cycle because there is not much scope, so to speak. Moving on from that to equity markets and valuation, what do earnings growth numbers look like? The expectation for the current year, March 25, is 7% earnings growth. And obviously, we are almost 3 quarters done. I'd say most companies have already reported their third quarter numbers, very few remaining, and 15% growth expectation for March 26. The boom period for Indian corporate earnings, funnily enough, turned out to be the pandemic. If you look at that chart closely, you'll see the green line, which shows you that between March 20 and March 2024, this 4-year period, profits compounded at 19% CAGR. And this is a period during which nominal GDP was barely growing in, double digits. But I think some part of that cyclical recovery, including the benefit of lower tax rates, is now in the base. So 15% EPS growth doesn't sound very aggressive for FY26, but keep in mind that the last 2 years, nominal growth for GDP has been sub 10%. If you look at the forecast for FY26, again, it appears to be a sub 10% nominal GDP CAGR. In that kind of a context, for the corporate sector to deliver 15% earnings growth will mean they will need the full benefit of revenue growth to translate into operating leverage benefits to create a 15% outcome at aggregate. Individual companies, certainly, I'm sure there are many companies that will manage it. But at an aggregate level, 15% is a reasonable number, but I just want to say it is not a low bar. It is a reasonably stiff bar that companies in aggregate will have to jump over. So that was a quick word on where we are in terms of earnings. Moving on to valuations, left-hand side, Nifty trailing PE, very much in the white zone. It is in the fairly valued territory. Forward PE multiple on the right-hand side, still in that slightly expensive territory. What does it look like when you look at the Nifty 50 in terms of price to book? You'll see that on the next slide. Here again, after going into expensive territory, it has actually cooled down and come back into what we would call the fairly valued territory. And the price to book is an interesting indicator because it's a very stable indicator, and it is related to return on equity, which you can see on the right-hand side is pretty much holding at a 10-year high in terms of return on equity. But if you do see large investments in the economy, I would submit that perhaps there's more scope for a little bit of give back of ROE rather than an improvement in ROE at this point of time. But certainly price to book and trailing PE multiples suggesting that the sell-off in the market, which is happened from early to mid-September to today, has reduced some of the froth in the market without doubt, certainly in the large cap space, but we'll talk more about that later. If you move to the next slide, this shows you the mid cap and the small cap. Yes, they have corrected, but honestly, I don't have much to say here except to say they still remain on an aggregate basis very much in the expensive zone, even more so as far as mid caps are concerned compared to small caps. So over here, unlike large caps, there has not been a mean reversion into what we would call fairly valued. Individual stocks have pulled back 30-40%. I was looking at the data as of yesterday. Close to 40% of the Nifty 500, which is 200 companies, have dropped more than 30% from their 52-week high. So yes, individual stock prices have corrected, but the fact remains that when you look at aggregate valuations, they still are looking slightly pricey as far as mid and small caps are concerned. Um, I'll just move on to the next slide from here. Now, I'd unveiled this slide to you earlier as well. This is our proprietary equity valuation index, which incorporates trailing PE multiples, dividend yields, price to book, and also the comparison of the bond valuation vis-a-vis equity valuation. And this index goes through multiple zones, which have been colored over there. And remember, this had gone into the decreased equity allocation zone about 6 or 7 months ago, but it's now pulled back comfortably into the fair value zone. The only point I would make is that this index, all the data that's feeding into it is Nifty 50 data, and therefore to that extent it's more a reflection of large cap valuations than it is of mid cap valuations. Now, I recognize that every investor might have a very different financial objective. Their goals would be different, their asset allocation and tolerance levels would be different. But this we are presenting as a guide to, as a way to think about asset allocation. And therefore, in today's environment, we actually think that this index level is suggesting investors can allocate towards equity because we are in fair value territory for large caps. So very quickly, the other sort of accompanying data on this slide is really those green boxes at the top. Based on the zone in which you invest, the previous slide showed you the red, yellow colors. Based on each of those zones, what is the average return that investors have experienced when they invest in each of those zones? As you can see in the fair value zone, the average 1-year return for the Nifty 50 works out to be 12% with a max of 44 and a low of minus 31%. These are all 1-year forward returns and the average is 12%, which we think is a decent return for equity, is well ahead of bonds, and that's why the indicator is now in that fair value territory. As you move into the higher allocation areas, your average return reduces. As you move into the lower allocation, into the lower valuation ranges, equity allocation increases because the average return is much higher. So that's the way to sort of read the table, and that's the way to use the table that I showed you on the previous slide. So final slide, just to sum up everything that we talked about. I've talked about the focus on fiscal consolidation. Please don't underestimate this. For India to be able to achieve its growth aspirations over the next 20 to 30 years, the sustainability of those growth aspirations, having a strong macroeconomic platform and good macro health parameters is very, very important. And I think we are not giving the government enough credit for what it is doing over there. I recognize the fact that therefore sometimes they have to make the difficult trade-off between trying to push for growth and fiscal consolidation and disciplined monetary policy. But I think in our long-term interests of sustained growth, this is the right way to go. We've talked about the supply side initiative and how it allows households to determine how they want to use the money. We've talked about the MPC. We've talked about the equities now being in fair value zone, particularly based on the large cap. So what should investors do in this environment? We would continue to recommend that asset allocation and risk management are key in the current environment. Yes, the large cap valuation indicator is back in the fair value zone, which is why the last line over there says, our preferred area of investment is large caps, but we would continue to recommend using a staggered approach towards even large cap equities. Simply because there are lots of associated volatility related to some of the other things which are happening in the economy. But certainly this is an area where you should be willing to, put your feet back in the water. A much better set of strategies to consider in the current environment are hybrid strategies. So balanced advantage, multi-asset allocation, equity savings, the aggressive hybrid. These are attractive because A, they are not 100% equity. So they give you better ability to tolerate market volatility. Valuations are not bargain basement cheap. So again, these have a healthy allocation to equity, but they're not 100% equity. Also, you're getting the benefit of positive carry on fixed income in the fixed income allocation of the portfolio. So that's why we actually think the hybrid portfolios are the best place for lump sum investments in the current market environment. Finally, we've been talking about this for a while. I think the last 6 to 9 months of data clearly shows now there is a bit of a trend reversal away from value and in favor of quality growth. And that's something to keep in mind once again when you think about allocation from a style perspective. So that's about the summary from my side. I'll halt over there and hand over to Vishal. Vishal is the fund manager managing the India Consumer Fund. He's been with us for well over a decade, and he started his career as a consumer analyst at UTI Mutual Fund. He's also looked at other areas like cement and telecom, so wide range of experience, and he'll talk about the strategy and how the India Consumer Fund is currently positioned. Over to you, Vishal.
Thanks, Vetri. And thanks everyone for joining, and good evening to all of you. Uh, sp- uh, since what has happened in last 1 week, specifically with the budget with respect to tax cuts, I think there's a lot of interest in how it will benefit or what it could have impact on the consumption. So we thought this could be a very appropriate time to discuss the India Consumer Fund. And apart from obviously the short-term impact, we'll also try to explain and discuss why we are bullish or positive on this consumption theme from a longer-term point of view, and how UTI India Consumer Fund is well placed to take benefit of that. Next slide. So just to begin with, I think one of the distinctions I wanted to make out, and we'll have more details in the subsequent slides, is that this is a thematic fund investing across subsectors within the consumption. So it's not a single sector fund. From that point of view, the volatility and the volatility which you generally see in single sector funds, this is far lower here. So we invest across sectors. It's a very well diversified fund across multiple sectors. Secondly, I think one of the biggest reason to be bullish on the theme, overall consumption theme in India, say for next 10-year view, is mainly because of the favorable demographic dividend. And I'll show in a subsequent slides with data that how India is now unique with respect to most major economies in the world, where we have positive demographics in terms of working age population. And we have seen historically, as your demographics are positive and you have larger proportion of population in the working age, you see a very good growth in per capita income, which drives consumption. And to add to that, the fact is that India is still at a much lower end of the consumption curve across most categories. So if you look at the penetration in many categories, and even in categories where penetration is high, the per capita consumption and the premiumization, there are a lot more opportunities available across sectors and across product categories. And what will happen is that because of this demographic dividend, as you see more income and more wealth, you will see the income pyramid of the country also changing. More and more people will reach the affluent class, which actually will give a lot of fillip to the discretionary consumption. And where do you invest in that sense also becomes very important. Which categories will do well in next 10 years actually could be very different from which categories did well in last 10 years. So from an investment point of view, it's very important to recognize those opportunities. And lastly, I think there are 3, 4 structural shifts which are happening in the consumption behavior. Some of it actually started much before COVID with demonetization and before that. And some of it obviously have picked pace, like the digital technology or shift to online more post COVID. So you have unbranded to branded, unorganized to organized, premiumization, using more of digital channels. I think those are the structural shifts, and that also we have to recognize, because you are seeing a lot more companies getting listed in the consumption space, which benefit from all these shifts. And finally, I think because we are obviously investing in stocks and companies, what we are concerned is not just with growth, it's also concerned with whether that growth translates into good cash flows and ROICs, because the growth has to be value accretive. So a lot of times there are a lot of sectors where growth is good, but they don't generate cash flows, or the ROCs are suboptimal. At least in this theme, we know that the underlying cash flows and ROICs are very healthy. So if growth comes back, actually that growth will be very value accretive for all the shareholders. Next slide. So just on the first point, as I was mentioning, this is a theme which invests across multiple sectors. And if I have to point out the larger sectors in this theme, one will be across consumer goods, which will include FMCG, retail, consumer durables, apparel, paints. Then the second largest sector will be automobile, which will include both two-wheelers, four-wheelers. Then we'll invest in telecom, will invest in media and entertainment, will invest in retail financial services, which are more B2C in nature and which directly interact with a common consumer, like mortgages, insurance, mutual funds, credit cards, etc. So anything which is B2C in nature is a direct investment opportunity for this fund. So coming to the demographic dividend, I don't want to share too much data and spend too much time, but I think this slide encapsulates most of the points which I was trying to say. And what I've done here is that I have taken example of two major economies, which is one which is obviously developed and one which is developing and obviously much ahead of India is China and United States. So if you look at the left hand side, on the working age population side, if you look at China, actually the absolute number of working age population is now reducing. If you compare from 23 to 2043, India actually it is increasing, while US is largely stable. But the more important thing, if you look on the right hand side, is that India is actually one of the few countries, larger countries, I would say, where actually the working age population ratio in the overall population is actually increasing from a 67% to 68%. While in most other countries, I mean, we have example of other countries like Japan, Europe, where everywhere it is actually declining. So what happens is that if your working age population ratio is increasing, which means that larger proportion of the population is working and less number of population is dependent on those people, the overall per capita income of the country actually goes up. And as the per capita income goes up, the disposable income goes up, it drives consumption across categories. And we have seen this across country after country, and we have seen this actually play out in China also very well in last 20 years. So I'll just now come to the other driving factors. So once you have the per capita income in place and the per capita income goes up, actually on top of that you have a lot of categories where penetration is far lower. And for example, I have put slide here of some of the durable and of the automobile categories. And what we have tried to do is that if you look at the penetration across different buckets of population, and we know that like in AC and car, four-wheelers, the overall penetration is actually sub 10%. But if you further split it, you will realize that outside the top 10% of the population in AC and automobile cars, actually the penetration is almost negligible. So as the income goes up and more the per capita income across the population at the lower end also keeps going up, more and more people will be able to afford a AC or a car, the penetration increasing. Similarly, if you look at a washing machine where overall penetration is 15%, a refrigerator where the overall penetration might be close to 35, or a two-wheeler where the overall penetration is close to 50%, even there you see actually across categories you have the bottom 40% of the population having very low penetration. And as the income growth percolates down, I think those population cohorts will also want to have a two-wheeler or a refrigerator or a washing machine. So this is an example on the durable on the automobile side, and the same thing actually you can see across categories, lot of categories. So you have the penetration opportunity which is still very huge in across many categories in India. And the other structural shift, which I already spoke about earlier, and the three major shifts which we are seeing, the first two, unbranded to branded and unorganized to organized, I would say that started many years back and maybe accelerated post the demonetization and the GST phase. And then you have the e-commerce, which also started actually pre-COVID, but during COVID, as people were stuck at home, actually it accelerated, and then new business models have also emerged out of it. So you have seen these structural shifts which continue to take place, and a lot of the companies which are actually benefiting from all these shifts have got listed in last 5-10 years, and which we think could be a very good opportunities to invest if they able to execute well, grow well, and at the same time become profitable and generate good cash flows and ROICs. So I put some numbers actually. I mean, I'll not go into the specific numbers of each and every category, but if you look at largely across all three shifts, you have some of those familiar categories which we think could benefit, which includes apparel, footwear, luggage, restaurants, grocery, jewelry, fashion. So the multiple categories which could benefit both from unbranded to branded, unorganized to organized, and shift towards digital channels. And lastly, just to end the whole top-down view, the one of the largest structural themes which has been playing out for, I would say, for last 10-15 years has been premiumization. And just to give an example, what we did here is that we have taken few categories and showed you how the growths have been in last 5 years and what is the growth expectation in the next 4 years. So just to take one example, if you take the soaps category, where there you have a bar soap at the basic end and you have a body wash at the premium end, and you will very visibly see that in last 5 years, while a bar soap has seen a 6% CAGR growth, a body wash has seen a 14% CAGR growth, and which is expected to continue. Similarly, if you look within plain biscuits and premium cookies, you will see that shift. And there are many such categories, and example after example, I just wanted to highlight few. So premiumization as a category or a theme continues to play out. This is important because a lot of times we get asked that there are a lot of categories where the penetration is already 100%. Say soaps, almost everyone in the country will use a soap. So what will drive growth in that category? And there the answer is, apart from per capita consumption, it is premiumization. As consumers income grows, they will want to use a better product in each category. I'll just come to the budget slide. Budget, I think some bit of it Vetri already covered. And I think as Vetri mentioned, the government has put almost 1 lakh crore of money in the hands of the consumer. And here we have put actually up to tax slabs of up to 50 lakhs. I think bulk of the money is in that slab, almost 97,000 crores. And if you look at the estimated tax foregone or the benefit, you will see the large part of the benefit comes in the population cohort of eight people earning anywhere between 8 lakhs to 20 lakh rupees. And I would say that is the working age or the middle or the population which has entered the workforce maybe few years back, 4-5 years back, and they have an aspiration to have higher discretionary consumption. So in our view, what this could end up doing is that obviously we can't take a call on how much the person will save or how much the person will consume, but potentially I think what this could do is this could drive lot of discretionary consumption across sectors like durables, autos, home decor, restaurants, premium beauty and personal care. And on the right hand side, I mean, we've seen that on an average, you're talking about anywhere between 2 to 7%, or on an average, you can say 5% kind of increase in the income, post-tax income, just because your obviously the tax outgo has reduced. So overall, this is a decent amount of money which has been left in the hands of the consumer. The consumer will decide how he wants to use it, whether he wants to save it or spend it. But potentially there are a lot of categories which could benefit. And we did some rough math. And if you look at a lot of these categories like two-wheelers, four-wheelers, durables, and if you look at the typical EMI which a typical consumer will have to give to buy that product in a year, actually lot of it matches in this bucket of 40,000 to 1 lakh rupees. So from an EMI point of view, actually the saving actually matches with how much spend will be required for those kind of products. So we think some of these products could be good beneficiaries of this move by the government. Also, I just want to add one more point is that if you look at it, since COVID, what has happened was there was a K-shaped recovery in the economy, and rural was really struggling. But in last few quarters, you had seen rural starting to recover, maybe due to a lot of welfare schemes done by states. But at the same time, we had started to see some bit of slowdown in the urban consumption. I think what this will do is that this will revive some bit of urban consumption. So rural, which was already recovering, and urban, which was slowing down, could actually now see some benefit and start to see some pickup. So both put together, it could benefit consumption. And as I mentioned, one of the good things about this theme or this sector has been that the underlying return on equity or underlying cash flows of the sector has been very healthy. So if you look at what we try to do here is that we compare the ROE profile of the Nifty Consumption Index, which is the benchmark for this fund, versus Nifty 500, which is the broad benchmark. And you look at it consistently, almost most years except CY20, which was a COVID impacted year, the ROE of Nifty India consumption has been fairly high compared to Nifty 500. So, which shows that the theme, obviously, underlying sectors or companies in this theme are fairly good quality. And on the valuation side, what we have seen is that because this theme has actually seen some bit of underperformance over last few years, and if you look at the 5 year last 5 year data, the valuations have also now come to almost 5 year average valuations. In between, the valuations had become very expensive, but I think post the correction of last 6 to 9 months, you have seen the valuations again converging to long term averages, and we have seen the similar. If we do the similar analysis on a relative basis, again we see that relative to we have not put the chart here, but what we have seen is that relative to even the broader market, actually valuations are in line with longer term averages. So now quickly, what I'll also give an update on the portfolio and how we think about the fund. Uh, this slide is just to differentiate how this theme is different from a normal diversified fund. So what we have done is that we have compared the index, which is Nifty India Consumption, with Nifty 50 and Nifty 500, which are the broad benchmarks for any diversified fund. And if you look at it, the one of the differentiating factors about this theme is that there are some sectors where it is significantly overweight, like FMCG, auto, consumer durables, consumer services, which is retail and telecom. There are few sectors which where this theme is significantly underweight versus a diversified fund, which is financial services, IT, oil and gas, construction, metals and mining. So as I mentioned, this is a theme which we invest in B2C oriented sector and mostly domestic B2C oriented sector. So we generally avoid export oriented companies or B2B oriented companies. So this is a direct play on the consumption growth of the country. And just to again compare the performance of this index versus Nifty 50, since this index was inception, Nifty India Consumption has given a return of almost 14.8% CAGR versus a 13% CAGR by Nifty 50. So coming to the fund, if you look at, I mean, there are mostly largely data points. The only thing I will mention from this slide is that although the index, which is Nifty India Consumption, has almost 90% plus in large caps, but we have almost 75% in large caps, and we have invested 25% in mid and small caps, where we find bottom up good quality opportunities in the consumption space, where we think the growth can be significantly higher than the sector. And this is the portfolio. On the left hand side, you see the top 10 holdings, and on the right hand side, you see the top 10 unique holdings which are outside the benchmark. And as you can see on the left hand side, in terms of sectoral breakup, so we are underweight on FMCG, while we are significantly overweight on both retail and durables, because we think that over a longer period of time, discretionary consumption in the country should significantly outgrow staples or FMCG, as the penetration levels are lower to begin with. And from a near-term view, from the budget point of view, also I think the potential beneficiaries will be more in the discretionary space compared to staples. I think we are largely done. Yeah. Thanks, Sonal. Sonal, over to you.
Thank you, Vetri and Vishal, for sharing your insights. The webinar is now open for question and answers. Let's begin with the questions that we have already received while other questions queue up. Vetri, my first question is for you. The budget and monetary policies are now through. From January to February, the markets have tried to stabilize a bit for now. What is your reading on the markets? What are the factors that are at play? From these levels, where do you see the markets are headed?
Sonal, I don't have a crystal ball, so I don't engage in trying to forecast where the market will go over the next few days, weeks, months. 30 years ago, I started my investing career and figured that is impossible for anybody to know. So I don't try and focus on what lies outside my domain, outside my competence, and what is honestly outside most people's ability to forecast. So I tend to focus on, is there an opportunity? Is there margin of safety? I think without doubt in the large cap space, there is now some reasonable valuation, some signs of margin of safety opening up. That is what the equity valuation indicator showed. And I prefer to be guided by what I know, understand, and what has long-term implications rather than trying to tilt at the windmill. So that's the way I would, suggest to investors. Be aware of your asset allocation, manage your risk, but this is a time where you should be willing, particularly in the large cap space, to be able to step back in the water.
Sure, Vetri, thank you. Vishal, my next question is for you. Post budget, the consumption theme has been quite in focus. There has been discussions happening about consumer discretionary versus consumer staples. Do you also lean towards consumer discretionary at this stage?
I mean, I think a lot of it I already answered during my presentation, but yeah, I mean, to put it very briefly, uh, given that what we are talking about in terms of already tax-paying population who will be consuming FMCG products, I think most likely this should benefit more on the discretionary side. Even within FMCG, obviously there are companies who have discretionary product portfolio. They have premium end of products in every FMCG category. So overall, I would say uh, discretionary consumption should see more benefit compared to basic staples.
Sure, Vishal, but no, despite some valuation corrections, consumption stocks still appear expensive, with many trading at P multiples of 30, 40, or even 50 times, especially those expected to benefit from government spending. Given this, why favor consumption over capex, particularly after recent correction in the latter?
No, I already had a slide on valuation. I would say that if you look from a both from a relative and absolute basis, obviously valuations are not attractive or not very cheap. But I would say valuations are no longer very expensive what they were say a few years back or even actually 9 months back when FMC sector was doing very well. I would say valuations are now largely in the average zone, both on an absolute and a relative basis. So are they expensive? I would say no. Are they like very very cheap and very attractive? That all answer to that also is no. But I would say valuations give some comfort as they are in line with long term average. And if the outlook for the sector is improving, and if you think the growth outlook can improve, I think it offers good investment opportunity.
Thank you, Vishal. Vetri, coming to you, I'm trying to piece the puzzle together. Typically, when the dollar weakens, money flows back into emerging markets, and when yields fall, it further supports risk on sentiment for emerging markets. Right now, the dollar is down, yields have started correcting, yet we are not seeing a clear reversal in the flows. So, where is the money going?
I don't think you can look at that correlation on a day-to-day, week-to-week basis. I think, these are longer-term patterns. There are some investors who are investing based on I shouldn't even call them investors. There are some investors who trade day in and day out. Maybe those are the hedge funds. And there are those who invest and hold positions for 5 years and 10 years. This dollar strength up, down, one day, 1 week, those are all the things for position traders to reallocate. Those are not factors which drive long-term capital flows. I would broadly agree with you that over the medium to long term, a very strong dollar over a sustained period of time, high US yields becomes a magnet for capital to flow to the US rather than capital to flow outside of the US. What we don't realize is that the US is the biggest recipient of FDI. The US is the biggest recipient of foreign capital debt inflows, and the US is also the recipient because it has such a wonderful stock market, the biggest recipient of FPI inflows into any geography, right? So when you have a strong dollar regime, it basically drives all these factors. If you see some weakness over a sustained period of time, then I think the outlook for capital flows might get slightly different. But again, I'm saying, these are all factors that keep changing. We have seen weak dollar, still capital inflow not coming. That also I will find you examples on a chart. So I would say act with what is within your zone of knowledge. What is within your zone of knowledge is what you should act on, which is your asset allocation, your financial goals, and where are you in the valuation cycle.
Sure, Vetri, it would be interesting to see those charts. But building on the flows, there has been continued selling pressure from FIIs. Is this primarily a result of India versus China dynamic, or is it more about a broader shift in global flows with capital moving from emerging markets to the US, leading to India's share of FII outflows.
So my answer to this would be, do Indians eat rice or do they eat wheat? Right? As you go from north to south, they tend to eat more wheat, and then as you come south, it's more rice. If you go west to east, again the west starts with eat more rice in the east. India is a diverse country. Even foreign investors are very diverse set of individuals. Some people are asset allocation driven. Some people have templates which drive their allocation. Some people are hedge funds. Some people are trading for beta. So it's very simplistic to say, oh my God, somebody is moving capital because of China. It's possible some hedge funds who really trade in and out very dramatically, they may have moved capital. But I don't think that is the template that long-term investors follow. But very quickly, I think two things have impacted India in recent times. One is that, which you rightly pointed out, but I don't think it directly affects India. When you have a very high US bond yield, bonds become a valid investment for any international asset allocator, and that to my mind is pulling money out of all stock markets into bonds. That's point number one. Point number two, the US has become a giant sucking machine of capital because it is now 55 to 60% of global equity benchmarks, and it is doing so spectacularly well. If you rank all equity markets by valuation, US will be right at the top in terms of valuation. India will perhaps be somewhere just below that, right? Now, when you've got these two expensive markets over there, it is a career risk for any asset allocator to go significantly underweight the US because it is 55-60% plus of the benchmark. India, 2.5-3%. Okay, I need to take some risk about on valuations. Let me do it in a smaller market. Honestly, my belief is with the valuation correction that we have seen in the market over the last 6 months, and remember in dollar terms, it's almost 4% more than it is in rupee terms. I think when you see the large cap market trade in attractive territory, you will automatically see some foreign interest come back into the market because remember, in some senses, some of these foreign investors have a longer term memory of India than even people who've entered the Indian equity market in the last 3 to 4 years. I know fund managers who've been investing in India and still investing for 30 years. I think if the valuations are attractive, you will see them return far more aggressively than you've perhaps seen in the past. But valuations need to be attractive, both absolute and relative, for them to change their stance.
Thank you, Vetri. Vishal, coming to you, give us a sense on what you are making of the entire Nifty FMCG space, the consumption basket, because after the initial run up that we saw on the budget day, the index has not been doing all that well. Do you believe this further drop that we keep seeing on this index now is making the stocks from this basket more attractive?
I mean, 1 week is too short a time to comment on the stock prices. Obviously, I think on the budget day, what really happened was anything related to consumption went up. And who will really benefit will, apart from the macro factor of tax cut, actually even a lot more depends on the execution of the company. So, and only time will tell which company will execute better and where the person who has got the extra money decides to spend on. So only time will tell that. As I already explained in my presentation, we can only have an hypothesis and position our portfolio according to that, and which we believe is more on the discretionary side. So that's how we are positioned. But eventually, it all depends on the execution of the company and obviously how much the money the final consumer wants to spend or save and which category. So I think it's too early to say who could be the eventual beneficiaries.
Just to
Sure.
add to what Vishal said, Sonal, one day price responses are a response to investor positioning, more specifically trader positioning. In the long term, which is 5 years, 10 years and beyond, stocks are slaves to earnings, not to positioning. So all this debate about who's buying, who's selling, this day stock went up, those are positional elements. If you are a position trader, of course you will discuss those. But we mutual funds, we are not in this for position trading. We are here to help investors create wealth to achieve their goals over 5 years, 10 years, 15 years. And in those time periods, earnings, cash flow, return on capital matter far more than positioning.
Thank you, Vishal and Vetri, for such a detailed answer to this question. Vishal, In this light, what is your current portfolio construction and how you plan to tweak it after the budget?
So our portfolio for some time actually has been positioned in a way, as I explained, we are more bullish on the discretionary consumption and nothing to do with the budget. Honestly, it's more that because the penetration levels in the discretionary categories is far lower and your income grows, the discretionary consumption should benefit more than basic FMCG. So that's how our portfolio positioning has been actually for, I would say, more than 5 years now, ever since I've been managing this fund. And nothing changes on that front because, as I said, our hypothesis is that this move of tax actually benefits more the discretionary. So don't think we need to really change the portfolio significantly because of this one event. Obviously, we'll be as always, we are always on lookout of good quality companies, good quality managements, which we think can execute better to take benefit of this opportunity. So as and when we find opportunities, that will find place in our portfolio.
Sure. Thank you, Vishal. In the interest of time, I will take only one more question. Uh, Betty, this question is for you. The recent imposition of tariffs by US President on imports from China, Mexico, Canada has significant implications for the global economy. How does such uncertainty impact globalization's architecture of supply chains, contracts, etc.? And second question on this is like, what could be the repercussions for Indian economy and markets?
So we can look at this in two, three different ways. When you have these kind of tariffs being implemented, if every country starts to say, I want everything produced within my borders, it does not create for efficiency in capital allocation. It does not result in goods being produced at the least possible cost such that it benefits the consumer, and it goes against the theory of competitive advantage. Now, I know you have to also align this with the fact that sometimes countries and geographies can follow policies which could be non-tariff related, which could make trade unfair. So it's a very complex topic, but be that as it may, every country is trying to say, I want to secure my supply chain within my borders, is not good for global trade. And as I said earlier, it is actually capital dilutive in some senses, because then every country is building capacity to meet its needs, which may or may not be possible. The second thing that I do think this does is that to some extent it dilutes the animal spirits of entrepreneurs, because it makes capital allocation decisions by entrepreneurs very, very difficult. If I want to build a big capacity in India, not only to service Indian market, but maybe even the US market, now what is going to happen to my goods if I manufacture in India and have to export to the US? Tomorrow, will the US start to impose a tariff on me? Similarly, let's say I'm a company with a supply chain which goes through China, Indonesia, India, Mexico, and then the US. Now, suddenly this has become a very, very complex puzzle to solve. And therefore, in a sense, I think it dampens the animal spirits of entrepreneurs and their willingness to make large investments, particularly in tradable goods. If you're in the non-tradable sector, maybe this doesn't matter so much. You look, for example, in the last 10 days, we have had announcements from, the big tech majors, whether it is Google, Amazon, Microsoft, Meta, all announcing capital investment budgets, which are like 30 billion, 50 billion. Yesterday, Amazon was at $100 billion of investments this year. But they are in the virtual world. So, they are not thinking so much about this tariff problem. But in the tradable goods area, this becomes a very, very big challenge. So I think this is unfortunate. It will slow down trade in tradable goods. And it is something that I would watch with a little bit of concern. From India's perspective, there are two ways to look at this. One, we are a domestically oriented economy. This we know very well. But keep in mind that exports of goods and services from India is 20% of GDP. Right? Only thing is it's equally divided between services and goods. So thankfully services not in the limelight right now. So our negative impact is lower. But the other way to look at it is that yes, we are a domestically driven economy. We can grow at 6.5 comfortably. But if we want to go to our aspirational rate of growth, which is 8%, you can only do this when the global economy is supportive and it is willing to allow what can potentially be a low cost producer to export its goods and services to you. There are very few examples of countries which have grown at 8% sustained levels over a long period of time without exports being a significant contributor. So that is the challenge for India. To get to our aspirational rate of growth of 8%, we need a global economy which is supportive, both in terms of capital as well as in terms of trade. Without that, can we manage our 6.5%? I think we can, and that's the good news for us.
Thank you, Vetri. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all our viewers for participating today and asking questions. We believe today's session provided you with enriching insights, offering a comprehensive update on equity markets and a deeper understanding of UTI Consumer Fund. We hope that your queries have been answered to your satisfaction. Please do share your feedback on the link provided. Special thanks to our esteemed speakers, Mr. Vetri Subramaniam and Mr. Vishal Chopda. And as we conclude, we encourage you to stay connected with us for future events and updates. We have our upcoming webinar on fixed income scheduled on Monday, 10th Feb, 4 to 5 p.m. Thank you and good day.
Thank you, Sonal. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.